Now diving into our questions. Now what I've done here is tried to provide as much of the same information as possible. We've got a bunch of different uh, ways we are using these formulas here, and it's relatively the same information. And this is how a question could be presented. It'll just give you this, and it'll say, give me the direct material price variance. Now, for your convenience, under the assumption you don't have it memorized, I provided all the formulas on top. Right here, direct material price variance. It's plug and chug. Right here, well, actual quantity purchased. Okay, well, this is electronics, TV, manufacturing. Let's see what we purchased. Well, if you look through all the information provided, now the information could be in a paragraph format, or maybe it's in a chart, table. Don't worry, trust the system, right? Trust the system. The system tells you, is what I'm telling you. It's going to be to have these formulas and just look for what you need. Actual quantity purchased is 700 pounds. We plug that in there. Actual price, have this memorized, which is great. Actual price. We look through, okay, actual purchase price, because think about what this is. We're not actual selling price. This is the price you purchased materials for. Actual purchase price is $12 per pound. We plug that in. And then standard price, conveniently placed above at $10. 12 minus 10 is, say it with me, 2. If you didn't do that, needed a calculator, please practice some more math. And then 2 times 700 is 1400, unfavorable. Now, generally, multiple choice questions, sims, etc., will have you plug in the number at its absolute value, meaning non-negative. So just read the instructions. Don't get tripped up by that. Don't lose points because you put it in negative or positive. Just whatever it is, read the instructions, and then it'll probably tell you to say favorable or unfavorable. Great start to running through these. This is the direct material price variance, very common one. Could be the direct material rate variance, spending variance. Those are other names for it, but it's the direct material variance for the dollar amount that you purchased them for. Now we're moving on to the direct material quantity usage variance. So this is the difference between the actual and expected unit quantity needed to manufacture our product. Hopefully we can use less quantity of materials. You just want to use less, right? That saves you costs and it'll save the environment. Use less. I'm all about that as well. Fortunately, a lot of businesses do not care, but hey, we are not here to talk about that today. If you want to hear about me talk about the environment positively, then we can do that some other time. All right. So this variance is very common in the production environment, right? And it is standard plug and chug, just like all the other ones. And what does that mean? I'm gonna use my nice pink color. Well, what is our standard price? Because again, you have this memorized. We look through, okay, standard price of our purchased items, because we're still in direct materials. Budgeted purchase price. So standard budgeted, same thing. $10 per pound. Awesome. Actual quantity used. Well, how much did we actually use? Okay, 700. And then standard allowed is 1,000. You see here, again, right? This technically is a negative number because 700 minus 1,000 and then times 10. Well, it doesn't matter. I'm putting these as positives. It's favorable. Use your brain. I'm sure you've got a great one. And think about it. Well, if we actually used less than what is budgeted, that's good. Very good. Congratulations. That would be favorable. Awesome, awesome, awesome. We're on a roll. Now, if this is starting to feel dry, don't worry. I'm having just as much of the feeling as you. No, have a good time. And you know why I'm having a good time with this? Because you see how simple this is? It's pretty, compared to what other things you could see on the exam. It's nice. There's not going to be crazy tricks here. Just master this and you'll earn your free points on the exam. Direct labor rate variance. Again, we're still having a good time because we want those free points in the exam. We want anything we can take that is not going to be absolutely mind-numbing. Well, we have actual hours worked. We are going to take a look at those there. 2,500 hours. This is the difference between the rate of labor, actual rate of labor minus the standard rate of labor. Awesome. And plug and chug, we see it's the dollar amount. So we have the dollar amounts in the parentheses there. Gosh, you're going to fully memorize this by the time it's done. And when it's dollar amount, we are at actual. Awesome. Saw the math play out. I'm just going to highlight different points as we go along to help you memorize. Okay, well, we see a direct labor non-dollar amount, it's efficiency. So it's standard dollar amount. And in here, actual hours worked minus standard hours allowed. And we will plug and chug those. So standard budgeted rate of labor, this is paying $20 an hour. Pretty solid as of recording this video, but who knows? The markets and everything change pretty rapidly. Who knows what you're getting paid to do? Anyway, so actual hours worked. How many hours were actually worked? It looks like 2,500. And standard or budgeted allowed normally happen is 3,000. That is good. We spent 500 less hours manufacturing TVs or whatever it is that Electronics Manufacturing Inc. does. Variable overhead rate spending variance. Okay, well, I didn't cover this as in depth as the direct labor and manufacturing ones, but it's nothing too crazy. As we'll see here, right, we have, okay, rate spending variances, and these names can be variable overhead spending variance, overhead rate variance, right, price variance. You could say a couple different things, but it's the variable overhead monetary variance. So actual non-dollar amount, and then in here, actual minus standard. As we have seen, well, our actual rate, $24 per hour, so we have actual overhead rate. You see I had to change some of the names of these, right? Like this was direct labor before. But yeah, read through all the information, make sure you're not falling for any tricks. Actual overhead, I guess that was a trick I threw at you. So $24 per hour is our actual. Budgeted is $20 per hour. Great to see as well. Awesome. Plugging those in, that gives us $4 and 2,500. While actual overhead hours is at 2,500, giving us $10,000 unfavorable. This variance is going to tell us in this, we're assuming we're the cost managers, the plant managers, right? More or less was spent on variable overhead than expected. Favorable variance is when we spend less. Unfavorable is when we spend more. Nothing too groundbreaking. All right. Well, the variable overhead efficiency variance takes the same approach as what we've seen for our direct materials and labor. We've got a non-dollar amount, non-financial, then we've got a standard financial, and then in here, right, boom, we've got the same thing. Now, seems a little bit longer. That's just what we're going to call it, standard hours allowed for actual production volume. Gosh, I'm out of breath there, but all is good. All is well with the world. Same plug and chug approach. $20 per hour of overhead rate, and we've got our two magical numbers here, and we are happy. That gives us $10,000 of favorable variable overhead efficiency variance because why is that? We actually spent less hours than we budgeted for. Great. I'm very glad to hear that. Right? We are isolating different components of our cost accounting, right? Of our cost process, and we are trying to analyze how did we do in each segment, in each area. As a cost manager, you want to see, okay, well, hopefully everything's variable. I mean, not variable, everything's favorable. And these variance analyses will tell you which is not favorable, which is, where can you improve? Gosh, I guess we can all improve, right? None of us are perfect, except for your significant other. Please go out and tell them, if you have one, that they are perfect. I'm sure they believe that. All right. Moving on to the fixed overhead budget spending variance. You gotta give me some credit. I'm saying a lot of these lofty words over and over. It's a great time. I'm having a great time, and you again are having a great time because you want these free and easy points on the exam. Now, they're only going to be free and easy if you memorize the formulas. Now, here's where we get to seeing them. They're a little different. This one, it's actually easier, right? The fixed overhead budget spending variance, actual fixed overhead minus budgeted fixed overhead. And let's think about that for a second. Why is that? Well, it's fixed. It's not going to vary depending on how many units are made. And we're just straight provided with those numbers. Budgeted fixed overhead, actual fixed overhead. Now keep in mind for some of these formulas, they might have you do one extra step. And I know you're saying to me, oh, Nick, like, why? You're telling me it's so easy, it's free points. Why? So I potentially have to do an extra step. And to that, I say, hey, it is what it is. It'll be easy enough, even if they give you an extra step. What is that? Okay, it might say the variance from last year, right? You have to determine what one of these is, and it's just one extra step. It won't be anything groundbreaking. Like, it's hard for me to even give you an example because it could be anything. Like, it could say it's the actual amount times the actual dollar amount. I guess give you a better example for one of these. Um, it could say the actual hours work. We had 10 employees who each worked 10 hours, right? That's a great way of explaining this, of saying that this is how to calculate the extra step. Or maybe we have 10 employees and they're all budgeted at 10 hours. That's another great way for them to add an extra step here and complicate it. But as you see by those examples, nothing too crazy, just an extra little multiplication step. But if you have those formulas memorized, you'll be in good shape. Now we have our fixed overhead volume variance. And this one, as you may see here, it's a little funky, right? We have a bit of a change from the normal formula, right? The standard formula. Gosh, I just keep using these words. I've just seen them way too much, right? Here we have budgeted fixed overhead minus standard fixed overhead cost allocated to production. And you see by this nice little star that to calculate this, it's actually actual production times standard rate. Now, this formula, obviously, as I stated, is a little different. Unfortunately, it's not as commonly tested as the others. If you have time, please memorize it. It'll help you. If you are in crunch time, focus on the ones before, and you will be just fine. It's just like you are Batman, right? And you got to pack your utility belt with all your tools, and your tools are your formulas. And you never know what you are going to encounter out in the field. And these formulas will be there for you in case you are asked questions about these. So, enough of that. Let's dive into the actual math. Well, budgeted fixed overhead, fortunately for us, is provided. Great. Awesome. There it is. 100. Cool. And then what about actual production times standard rate? Well, as you can see here, got 2,500 actual production units, standard rate. That seems to be $20 per hour, giving us our unfavorable $50,000 fixed overhead volume variance. Another great one to add to the books. Two more for you. We've got here the sales price variance. Now, as I mentioned before, this one is very much trying to indicate, did we sell the product for, right, like a better price than what we budgeted? Let's see. In this case, let's see. Okay. We have actual selling price. What did we actually sell it for? Well, we actually sold it for $120 per unit. We budgeted that we would sell it for $100 per unit. That gives us $20 of improvement per unit. And actual units sold, well, that's probably a good marker to use, right? Actual units sold, 8,000, plug it in there. Boom, we have $160,000 favorable. Right, same formula here. We've got dollar amount, right? And then what is outside the parentheses? It's actual units sold. This is a non-dollar amount. Same as what we've been seeing all throughout. All right, finishing up here, we've got our sales volume variance. And what is this? It's got a little bit of a different number in here, but no worries. Do not fret. Do not be alarmed. I am here to walk you through it. All right, we have actual units sold minus budgeted sales units. Well, we know that this is going to be unfavorable right away because of what's in the parentheses. We look at actual units sold. We sold less than what's budgeted. We know it's unfavorable right away. Awesome, got those knocked out. Just wanted to address that. We've got this part under control. Now, if you are familiar with contribution margin, great. You are not, no worries. You will see it in our forecasting and projections lesson. This is in what is going to be referred to as cost volume profit analysis or break-even analysis. I likely will call it break-even analysis, but CVP or cost volume profit analysis is a very valid name for it as well. All right, and what is the contribution margin per unit? Well, it's essentially what you get to put in your pocket. It's the selling price minus the variable costs. Per unit, what do you get to put in your pocket? What money? your profit margin essentially. Well, selling price right here, $100, and it's standard, right? Standard. So we're using the budgeted amount, $100 per unit. And then we got to look for all our variable costs here. Okay. What would those be? Well, that would include variable overhead, variable direct materials, which are variable, and then direct labor. Now, I don't see any overhead, so we don't have any. Great. But I do see labor and materials. Awesome. Well, I see, let's do materials. We've got budgeted purchase price of materials of $10. Budgeted pounds per unit we need is 3. And that's how we get $30 of direct materials. Okay. And what about labor? Well, labor, we have budgeted hours per unit of 1 hour, and then the budgeted labor rate is $20 per hour, so that's $20 there. $100 minus 20 minus 30 gives us $50 of a contribution of a standard contribution margin per unit, meaning standard budgeted, we have $50 to put in our pocket per unit. Awesome. So then we just do $50 times 2,000. We get to $100,000, and that is, as we mentioned, unfavorable. And just quickly, you know it's unfavorable because all you got to do is look at what is in the parentheses.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.